If you own or are considering buying physical gold or silver for your retirement, this might be one of the most important messages you hear right now. The precious metals market is on fire. Prices are surging and we're seeing volatility. That's exactly where this story begins. Before we begin, remember to like this video and subscribe for more economic updates. For years, the reasons why people chose physical gold and silver for their retirement accounts have been consistent and clear. It wasn't about chasing hype or quick flips. The strategy was always straightforward. Protect retirement savings from paper market instability. Preserve purchasing power against inflation and dollar weakening. Build genuine long-term security outside the financial system. Nobody ever said, I'm buying physical gold and silver for my IRA to capture quick profits next quarter. That was never the plan. And right now, something is happening that, quite frankly, I find a little amusing. When all the reasons why they originally purchased are being validated in one of the strongest price increases ever, some IRA investors are beginning to act like day traders. When did this happen and why? For anyone making these short-term moves at a time like this, I have one simple but direct question. Have any of the fundamental reasons you had for buying metals changed? Is government debt lower? Is spending under control? Is the dollar stronger? Are geopolitical risks calmer? Are paper markets more stable? The answer is always no. In fact, every driver that pushed people toward metals in the first place has intensified. Inflation pressure hasn't gone away. Central banks are still buying gold at historic levels. De-dollarization continues. And industrial demand for silver keeps skyrocketing during ongoing supply shortages. That's precisely why prices are exploding the way they are. The irony is thick. Think about it. Right at the moment when all the original reasons that an investor bought gold and silver are being proven true, some investors are deviating from the long-term plan to take quick profits. If you're selling physical metals just to rotate back into paper assets, ask yourself, where exactly are you going? Do you suddenly have more confidence in the dollar or the paper markets than when you first moved money out of them? Financial institutions would love to see those funds returned. After all, they make money managing paper. But the outlook hasn't reversed. The same pressures that pushed investors towards metals are still here and accelerating. And that leads us to the flashpoint everyone's talking about right now, buybacks. A surge of short-term selling has flooded the physical market. When sellers far outnumber buyers, even temporarily, liquidity gets strained. Dealers hold more inventory. Major wholesalers pause on certain products. And dealers have to manage capital responsibility to maintain liquidity for ongoing buying and selling. The result is different spreads and buybacks compared to calm markets. To someone used to pushing buttons on a screen, watching a digital price tick and executing instant trades in the paper or ETF world, this physical reality can feel completely disconnected. This isn't paper. It is real metal. It has to be received, verified, stored, insured, hedged, and eventually resold. Physical metals were never designed for tick-by-tick trading. That world belongs to paper ETFs and the futures market, where one person's high is another person's low. I've seen the misunderstanding and frustration turn into negative reviews, even from investors walking away with double or triple profit on their original investment. Think about that for a second. In almost any other asset class, stocks, real estate, crypto, a 2x or 3x return would have people celebrating, grateful for the profitable exit and the liquidity provided. But here, a short-term trading mindset flips it all upside down. Instead of excitement over gains and real cash in hand, the focus becomes whether the prices match spot exactly. In my opinion, that's day trader mentality colliding head-on with physical reality. I'll leave you with one quick word on how to decide what sources to get your advice from. Traditional advisors and accountants don't live in the physical metals world, and they rarely navigate physical metals liquidity in a flood. And if you ask AI for advice, it reflects the bias of your question back to you. So if you ask AI why buybacks are low, it will fuel your frustration. And inversely, if you were asking AI about overwhelming volume and dealer risk, you'll get a completely different point of view. This is my personal perspective from years in this space. If you own physical gold and silver, hold it. If you don't, buy it. Central banks continue to be on a buying surge. The world is de-dollarizing and geopolitical tensions are growing. All the reasons to be a long-term holder of physical gold and silver exist more now than ever. But if you decide to take profits, focus on your gains and enjoy them.